Hello, everyone, and welcome back to Your Finance TV. After a week's break, we have Jay Pelosky back here this week to go through his musings. How are you, Jay?
I'm good, Scott. I missed you last week. We wrote our musings. The title last week was Boom Boom, and I thought to myself, who would appreciate Boom Boom more than my friend Scott? So you missed it. Sorry, buddy.
But I do get the musings this week, and as you always say, we're looking forward. And I feel like you may have, with the title this week, you may have gone something that's a little bit back in the past. It's like Sherlock Holmes. It's Elementary is the title this week.
I didn't even make that connection. But yes, indeed, elementary, my dear Watson. And it came to us, as these things normally do, when we were getting ready for a Bloomberg TV appearance earlier this week. And it just struck us after all the action with the Fed and with the PBOC and with the Chinese government, putting out big announcement after big announcement, that it really was one of those times where, for investors, we believe it's elementary. And when things are elementary, what we mean is we want to keep it really simple, right? We don't want to overthink things. We don't want to get distracted. It's really pretty basic. And we even write in the musings this week about the old KISS philosophy, right? Keep it simple, stupid. Well, in this case, yeah, if you're not keeping it simple as an investor, you're being stupid.
So, all right, let's dig into it then. Like jokes aside, on the elementary side, like what do you mean? Like it's just elementary for this?
Well, we mean we want to focus on the big building blocks of what makes a bullish case. And so we can identify, I don't know, I have like four written down here. One is a synchronized global rate cutting cycle. And B of A just put out a report this morning noting that September had the most rate cuts. I think it was 26 around the world, the fourth most in a month in history. So there's no doubt that rate cuts are global. We had the Fed cutting rates opened the door, we believe, for the Chinese activity, for the PBOC to cut rates, and for China to really kind of go full on policy. We believe a full on policy move. So that's the second. You've got the two biggest economies in the world, the two major central banks of the world, the PBOC and the Fed, moving in tandem, moving in sync to stimulate and sustain, in the case of the U.S., the global and U.S. economy. And when we think about the global economy, this is the third support, to keep it simple. When you think about the global economy, you think about an economy that's, it's not booming, but it's growing fine. It's in a place of stability, according to the OECD, sustainable growth of around 3%, a little bit more for the global economy. And there are no major imbalances, right? Pretty much fully employed economies, consumers cashed up, companies cashed up, buying back stock, not only in the US, but in Japan, in China, big time stock buybacks. And that leads us to the fourth pillar in this keep it simple construct, and that is earnings and margins remain robust, right? And so when we look at forward earnings growth, so we're obviously coming up on Q3 earnings these next couple of weeks, but we're talking about 12-month forward earnings estimates. And they are for double-digit earnings growth in the US and in the Asia Pacific region, as well as high single-digit earnings growth in Europe. And so when you put those four things together, the old adage is you can, keep things in threes. So we'll go one more and say the four pillars of the keep it simple philosophy. It's elementary. That's all we really need to think about as investors. And with those things in sync, then we can be constructive.
Okay. Now, I actually love the show we did 3 or 4 weeks ago on buy the laggards because as you get to year-end trades and so forth, that's a big push you see from wealth managers and so forth, like what's underperformed, what's outperformed. Talk to us a bit more about buy the laggards and how it actually rolls into this and its elementary.
Well, that's exactly right. When you are making a case for a sustained, global economic growth period, as we are, then you want to look to buy the laggards. And we think there are some just significant opportunities in that laggard space. And we identified several back then, which have, frankly, worked out pretty darn well. And among them were China Tech, right? Our K-Web position, which has been, pretty painful. It's had a kind of up and down period the last for most of this year. Up strong early in the year, gave it all back, and now has popped again, such that K-Web is massively outperforming U.S. tech. And it happened in the space of 2 or 3 weeks. So again, that kind of very quick, very aggressive market action. And B of A has some great charts. One of them shows that emerging market equity relative to U.S. equity is at a low that has not been seen since 1969. Now, you probably weren't around in 1969. I was. I was not in the markets at that point. But point being, that's a long time ago. And another chart that they pointed out was that China's equity weight in ACWI, so All Country World Index, the Global Equity World Index, China's weight is at, multi-decade low relative to ACWI. So that's an example. We want to be buying EM. We want to be buying China within EM, and we want to be buying China tech within China equities. And we would just point out that this week, China tech, K-Web, has broken back above its 50, 100, and 200-day moving average, which gives technical support to the position. The second example would be commodities. And we've been quite aggressive on our commodity weight. We've been very aggressive on our fixed income underweight. Remember, we've been zero weighted in treasuries for roughly the last couple of years. And that weight has been split, therefore, between equity overweight and a commodity overweight. So we've been bullish commodities. And again, you see the same type of thing. Commodities are very underowned. I think we mentioned a couple of weeks ago, B of A highlighted that institutional allocation to commodities were at a 7-year low. This week, they pointed out in their year-to-date flows chart, which is just fascinating, right? Equities and bonds have taken in about $475 billion each year-to-date. Commodities have taken in a whopping $20 billion. So 4% of what has gone into equities and bonds has gone into commodities. And like K-Web, GSG, which is what we use as our benchmark, the ETF GSG, we use it as our benchmark for the commodity position in our global multi-asset model portfolio. It too has broken back above 50, 100, 200-day moving average. So you've got some kind of technical support, fundamental support of parts of the global asset classes that have been just, ignored, neglected for years. And that's one of the things that really is exciting to us.
All right. Well, so when we take all of this in, Jay, and obviously we've talked about K-Web a lot, we've talked about commodities a lot, and congratulations on that K-Web and the move it's had. What is the bottom line to all of this, though?
Well, yeah, I think the bottom line is really interesting. But K-Web, I just want to make the point. I made it last week, but since your audience, we weren't able to talk, let me make it here for this group. K-Web is illustrative, not unique. And what I mean by that is you look at K-Web, it's gone now in the last month from 25 to I think 38 today, just to give you an illustration, right? So like a 50% move. But it could easily double again, all-time high. K-Web's all-time high, 21, okay? And probably is due for a rest, right? I'm not sure I'd be piling into it right here. It's massively overbought. But on a pull, it's a healthy pullback. And if you're not in there, you should look to get in because it could go from 35 to 70, and then it could go from 70 to over 100 to get back to its all-time high. And that's at a point, obviously, where U.S. tech is close to an all-time high. And the U.S. equity market's at an all-time high. So this is what we mean. There's tremendous moves. And so this is the bottom line, right? There are two strands of thinking that are coming together at the same time, which we think is a pretty unique and very powerful indicator of future risk asset opportunity. So we observed the first strand in what we call our Global Risk Nexxus work, where we look at economics, politics, policy, and markets. You and I know this because it's the basis for our monthly. We talk about it every month. That's coming up next week. So when we look at that work, we notice economics, politics, and policy continuity across the three main regions of the tripolar world: Europe, Asia, and the Americas. That is quite unique. Okay. When you add to that the second strand, which is that you have a situation where, as we just touched on with KWEB and commodities, there are vast parts of the global risk asset marketplace that have significant upside to them. All right. And we just gave you the KWEB illustration. Again, it's illustrative, not unique. If you look at thematics, the same thing. KWEB, if you look at it in the last month, looks like it's a rocket ship. If you zoom out, remember we did a piece maybe a month or so ago titled Zoom Out, Not In. KWEB is a perfect example. If you zoom out to a 3-year chart, you'll notice that for the last 2 years, KWEB has done absolutely nothing. If you zoom out to a 5-year chart, you notice that 2021 peak at over $100. And so to us, there's this really powerful combination of supportive economic, politics, and political continuity across the tripolar world to deal with things like AI, to deal with things like climate, right? To reshore on the supply chains, all the things we've talked about for a long time, very clearly in place. And at the same time, you have this unique set of conditions where, because the market and investors have been so focused on US tech for literally the last 15 years, since the bottom in 2009, US clearly dominant place to be. That means now that there are huge parts of the market that are neglected, have been neglected, and offer dramatic upside opportunities. And the combination of those two things, that melding of the global risk nexus across the tripolar world, coupled with huge source of the global risk asset marketplace with tremendous upside, those two things combine to make what we have been calling the global blue sky macro outlook for 2023 to 2027. That's what we're focused on here at TPW Advisory. That's what our clients are benefiting from. And we believe the opportunity set today really is in those laggards: EM equity, EM debt, commodities, small caps, thematics. I mean, I just gave you five areas. That's just an example. Tremendous opportunities.
Okay, but what are you going to be focused on this weekend, Joe?
Duke football, baby. 5-0. Looking to go 6-0. First time. Duke football's a laggard, right? Duke hasn't been 5-0 to start the season in 30 years, since 1994. So it's an exciting time in Durham. And as we talked about earlier, my kids are up and grown and out of the house, so I don't have much to do once I get done with the musings, other than to watch Duke football this Saturday. And I'm looking forward to that. We got to beat Georgia Tech down there in Atlanta, and we'll be 6-0, baby.
Well, it's a big game for you. Enjoy the game, Jay, and we'll talk to you next week, okay?
All right, buddy.
And for everyone else out there, good luck investing.